Are the lows in? My next guest says yes, and he's staying overweight equities. Ryan Detrick is Chief Market Strategist at Carson Group and joins me now. Ryan, great to have you back.
Thank you for having me back. There's plenty to talk about. I'm excited to do this. Thank you.
Yeah, certainly a lot has changed since you were last on back in late December, but you're making a pretty clear call here. You think the lows are in. What gives you that confidence, Ryan?
Yeah, there's a couple of things. What's really interesting, the time we're doing this, the S&P 500 is exactly flat on the year. You think about all the headlines, all the stuff that's going on, and we're flat. I mean, after, 2 years in a row of 25% gains, last year about 18% total return. We're in a midterm year. I know last time I was on, we talked about midterm years can be choppy and frustrating. We're aware of the headlines. We're aware of the headline risk, the volatility in oil. But you get down to it, there's a couple things that I think we've been watching that we're optimistic about why the lows potentially are in. We had about a 9.1% peak to trough correction on the S&P 500 recently. Obviously, yes, the war and the spike in the energy markets caused that, but most years have about a double-digit return. But we've seen over-the-top fear, over-the-top kind of skepticism, and now on this rally, we're starting to see the right things lead, like technology has been leading the last couple of weeks. The market is broadening out. We can get more into the weeds of it, but listen, we're not shocked. The first, let's call it the first half of this year maybe, is kind of choppy and frustrating. After the rally that we've seen, that makes sense. But the underlying fundamentals, we can get more into that, earnings and things like that, those are still why we think this is still a bull market.
Okay, still a bull market. You mentioned the S&P 500 is flat year to date, only about 2% off the all-time highs. Where is it going to go from here?
Well, great question there. We still think low double-digit returns this year make sense where we came into this year, and we're still there. Again, a couple things to think about here. This bull market just turned 3 years old last October, right? The bear market 2022. We looked back at, over 50 years. 5 other bull markets made it to this point past their third birthday. The average length of those 5 was 8 years. The shortest any of them went was 5 years. So I understand this is just history, but sometimes history is a guide. And to think that this is an old bull market, we'd say no, not at all. In fact, it's a fairly young bull market, which I know kind of is opposite what a lot of people think. But then you peel back that onion. We're looking at record earnings right now. We're looking at record profit margins. We're looking at a market that's broadening out. I don't think most people realize this. Small cap technology, mid cap technology, and equal weight technology all last week closed at their highest levels in history on a weekly basis. Semiconductors also closing near all-time highs or right at all-time highs. Parts of the market are weak. We understand that. But to see that leadership from tech taking the baton back, I think kind of quietly, is another sign that this indigestion we've had the first quarter, the first 14 weeks or so of this year, it could be over fairly soon, and we could be back to your regularly scheduled bull market being led by strong earnings.
But we also have this blockade of the Strait going into effect, stalled peace talks, it seems like, oil right around $100 a barrel, the president threatening 50% tariffs on China. Are investors underestimating any of those risks?
Well, it's famous last words. We're going to find out on that. Now, I will say this much. When it comes to risk, yes, we're overweight equities. But what we do with the billions of dollars that we manage at the Carson Group, we have equities, yes, but we think about that other part, right? Bonds. Well, bonds haven't done well because inflation has been stubbornly high. Clearly, everything going on with the war has kind of pushed back the idea of any potential Fed cuts anytime soon. But then you look at things like, again, gold is still up double digits this year. Silver is still there. Managed futures have done well. Shorter term bonds have done a little bit better. So, I think we say diversify your diversifiers. So that in the old days, 60% stocks, 40% bonds, set it and forget it. Well, that's not where we are anymore because bonds are not necessarily zigging when stocks are zagging. So having this diversified portfolio and everything you just listed are very, very real concerns. But look around the globe. U.S. is like flat at the time we're doing this. Most other stock markets are actually up on the year, right? The ACWI All World as of Friday was up 2% on the year. I'm not saying up 2% is a spectacular thing, but then you look at all the headlines and all the worry, and it's like the market is smarter than any of us. The market is going to do what it's going to do. And as terrible as the war and all the uncertainty is, if everyone's thinking alike, somebody isn't thinking. Last comment on this. We've had like 8 weeks in a row of more bears and bulls on the AAI sentiment poll. You look at hedge funds; they're about as short as they have been in years, like a 100-year pandemic and bear markets. There's a lot of reasons to think. Listen, it's not about good or bad; it's about better or worse. Yes, things aren't good out there, but are things going to get better? We think they are, and I think the market. Again, yesterday when futures opened on Sunday night, everybody's freaking out, rightfully so. Crude oil up 10%. SP futures down 1.5%. And now you're getting past that, and the realization is the market is telling us it likely wants to go higher. Again, not better. It's about better or worse, and things are getting a little bit better.
Does that mean any pullback from here? We thought we were going to have one this morning. Doesn't necessarily seem to be the case, seeing green arrows across the board now. But does that mean any pullback from here is a buying opportunity?
Yeah, great question there. We think it is. I mean, we think so. Given we're overweight equities, I better answer that way, I guess. But the reality is we had the 9% pullback, and I know it's more. I mean, the reason so many people feel the way they do because the headlines are the headlines. But from an investor's point of view, the popular stocks, your Mag 7, a lot of those names have obviously been really hit. What's been leading this year is like industrials, boring old industrials. No one really owns a ton of boring old industrials, But again, that's why we've been preaching to keep this diversified portfolio, not go all into any one particular shiny object, as we call it, and stay overweight. And again, look overweight equities and looking around the globe, there's still opportunities because as bad stuff happens, particularly in the U.S., potentially other parts of the globe could do well. But I will say this much, last thing on this one. Since the war started, what's been happening? U.S. has done better relative to the rest of the globe. What did we see last year? The rest of the globe did really well. The first, we'll call it 3 months or so, 2 months or so this year. The rest of the globe did better. We think there's a good chance the U.S. is going to take back that baton by having a little bit better growth than the rest of the globe. The second half of this year being led by strong earnings, and the U.S. is still a place that you want to be an investor in.
Okay, so I want to dig into that, but first, just tell us, we've talked about you being overweight equities. Where are you seeing the most opportunity right now?
Yeah, great question. Technology specifically. I mean, technology is one area that, this time 4 or 5 weeks ago, everybody didn't want to own technology. They're going to buy the staples at 25 times earnings. That kind of felt a little lopsided. So I think technology is an area that looks nice. We do like it. You just slice and dice it a little bit. Telecom inside of there. I'll tell you software. I know software has been beat up. We understand that. Been a very weak area. But software is the one area that if it can really turn around, and we think it can, that's another nice reason to think you can be optimistic the second half of this year. And I mentioned already industrials. I mean, industrials are the kind of the Jan Brady group, right? No one's really talking about them, but they're doing really, really well. So industrials, technology, maybe even parts of financials, which have been beaten up and are very, very cheap. And by the way, technology is like as cheap as it's been in years. Everybody loved it 6 or 7 months ago. Now nobody wants to touch it. But again, one more thing on financials are really cool. If you look at insiders, we're seeing huge insider buying on technology companies the last couple of weeks. So again, those are some things to think about from that side of it. So industrial, technology, 2 groups we do like here the rest of this year.
And you can talk individual stocks, but when you talk tech, you mentioned software, but are you thinking Mag 7 or are you thinking other technology names?
Yeah, great question there. I mean, no, we think Mag 7 makes sense. I mean, the Mag 7 names that are beaten up and were overloved and overhyped this time a year ago. Oh, what was it? It was the Time Magazine Person of the Year in December last year. And all the AI architects, right? All the great AI companies, which have done amazing. At the same time, that's a high bar. And now nobody wants to own those names. So I think the Mag 7 makes a lot of sense when you get into it. And I'll tell you also on software, I can't mention like specific, but there's some well-known software ETFs that we've actually gone into in some of our more longer-term longer-term investing portfolios a year or two from now. There's a lot of software names that, yes, have been beaten up, rightfully so, with all the uncertainty over AI. But similar to last year when we had a lot of selling around DeepSeek and those concerns, which were kind of, in the end, overblown, I think we're going to see that take place once again.
Okay, and you brought in international, but think that the U.S. is going to take the baton. So does that mean how should investors be thinking about international exposure now, given higher oil, economic factors, recession risk?
Mm-hmm. Yeah, a great question there. So we came into the year, we had a little bit more European exposure on a relative basis, but since everything's happened with the war, we understand Europe's going to be more hit. The higher oil prices are, and natural gas specifically, are going to hurt Europe. But I want to be very clear, we think it still makes sense to own different buckets. Like if I'd joined you a year or two ago, we were pretty optimistic that U.S. is going to do really well. We're not so sure now, right? We think this is a global, I think the U.S. is going to do just fine, to be clear. But this is more of a global bull market now, so you want to have different pockets and different sectors. But I'd say we like the U.S. the most, developed international second, and we'd put emerging markets third. But in the portfolios we run, we definitely have exposure to all three of those. But that's kind of how we'd rank them here.
What areas of the market would you take profits in right now?
Ooh, that's a good one there. I mean, honestly, not on equities because there's not too many stocks that are up on equities. I would go kind of what we don't like or we're underweight. I mean, we can talk about bonds a little bit more. I mean, bonds have not done that well this year, right? I mean, and we understand why. The higher inflation, the worries about the war, the fact the Fed's not going to probably be cutting anytime soon. So we'd still say kind of be a little bit underweight your fixed income area of things. And also on the defensive side of things, like utilities, healthcare, staples, the more defensive things by nature, they did well, obviously, when things were, with the war going on. But now the last 3 or 4 weeks or so, they've been weak. So those are some areas that I think you want to get out of the more defensive areas and into more of the cyclical growth areas as we head into the second half of this year.
So Ryan, you mentioned price action, you mentioned history as a guide. Fundamentally speaking, what is it that underpins your bullishness right now, and what would change that view?
Yeah, great one there. So I think it's as simple as earnings continue to be extremely strong, right? We're looking at our 6th quarter in a row of double-digit S&P 500 earnings growth. We think that's going to be the case. I know it's very early. Just last week, we had Delta come out with, Delta said like their best 5 days ever have taken place since after the war. Because, yeah, they hiked prices, but people still buy tickets. Now, I get it. There's going to be an area where prices go too high, and that changes. But the reality is we're looking at S&P 500 earnings so far this year, up 7%, right? We just talked about it. Market's flat, right? So market's flat, but earnings going up 7%. Stocks are cheaper. If we, back in December when we talked, we said one potential worry, we were bullish, yes, but stocks were a little pricey, but now they're not. They're not nearly as pricey when you look at that. So those are some things to, I think about from an investor's point of view.
Bottom line, what's your message to investors right now?
Yeah, great one there. So stay in the game, right? The headline's going to be bad. Everyone's going to tell you how bad it is. We've seen this before. Every single year has volatility. Every single year has bad headlines. Of course, you should pay attention to your money. You should pay attention to what's going on out there, but also understand that the underlying pinnings that got us here, like you asked me in that question right before, are stronger profits and stronger profit margins. We call those the dual tailwinds of this bull market. Been calling those that for 3 years now. And we are looking at, again, this time at the end of 2019, profit margins were 12%. Okay, what's that mean? Well, they're a record 15% right now. We've been told for years profit margins only have one way to go, and that's lower. That hasn't happened. So profit margins keep trending higher. Earnings keep trending higher like we think they're going to. Those are going to continue to likely say that the overall equity bull market that we are in here in the United States and honestly globally is still alive and well.
All right. I think that's a great time to transition to our rapid fire game of this or that. You've played before. Quick questions, quick answers. Are you ready?
All right. Yeah, let's see what happens. Let's do it.
We'll start with an easy one here. Bull market, alive and well or at risk?
Alive and well.
Middle innings or final stretch?
Oh, middle innings.
War premium, priced in or still at risk?
No, it's not priced in. I don't think the war is. I think the war is overblown from an equity point of view, and I think it's going to be over soon and still bullish.
Too much fear in the market or not enough?
Oh, there's way too much fear, and again, from a contrarian point of view, that's a good sign.
Market from here, grind higher or break out higher?
No, breakout higher.
How much higher?
Low double digits makes a lot of sense for the S&P 500 before all is said and done. Flat right now, so you're talking another 12, 13% before the end of the year.
Add risk here or wait for a better entry?
No, add risk. There's a lot of reasons to think this market wants to go higher.
U.S. or international?
U.S., but have a little bit of international in there, but overweight U.S.
Growth or value?
That's a good one. We're more, I know it's boring. We're more even that, but I'd say maybe right now look at technology on one side, industrials on the other, so you kind of hedge to have a little bit of both.
So S&P, market cap or equal weight?
We'd stick with market cap. We think large cap's going to do a little bit better than small cap second half of this year.
Okay, I was going to ask large caps or small caps, but you already gave the answer there.
Oh,
Tech
there you go.
leadership or broader market?
I think tech's going to take back that baton after lagging for a while.
Industrials or defensives?
Industrials. The cyclical economy is stronger than people think. Industrials for sure.
Bonds, essential or dead money?
They're dead money, but you still should own some. But we would say look at other parts of your diversifiers. We don't like bonds all that much.
Hard assets, hedged or hype?
No, you should hedge. I mean, you should own some hard assets. If you drop it, it hits your foot and it hurts. Those are things you want to own, maybe in place of bonds in this particular environment.
Oil at 100, sustainable or temporary?
No, it's temporary. I think we're going to get some good news there. No, the oil's probably going to go back lower here.
Oil trade, sell it or buy it?
No, we would sell it. Awfully extended in the oil trade.
Fed, done or not done cutting?
Ooh, we'd say not. I'd say, I'm supposed to give you a quick answer. They're on pause the rest of this year, but I don't think we're going to see any hikes.
Resilient economy or delayed slowdown?
Now, this is a very resilient economy led by earnings, strong corporate profits, and still a pretty solid labor market, honestly.
Labor market, weakening or cracking?
No, we would say actually improving. So neither. If you look at it, the unemployment rate's still low. There are still some signs that we're seeing it's a low hire, low fire world, but we think the second half of this year, labor market improves.
In one word, biggest opportunity right now?
Equities? One word. It's tough. Stick with equities.
In one word, biggest risk right now?
Oil.
Finish this sentence. Investors should be blank right now.
Should be cautiously optimistic.
Ryan Detrick, always a pleasure. Thanks so much for playing along and for your insights. We always appreciate your perspective.
Thank you for having me. I look forward to the next time. Appreciate it.